Welcome to Success Finances. My name is Scott McLean, and for today's video, we're going to be discussing how to calculate your mortgage so you can come prepared to the negotiation table. All right, so is anyone out there looking to buy a house? Or have you ever wondered how the bank came up with all those numbers included in your monthly mortgage payment? Well, in this video, we're going to look at teaching you how to calculate your own mortgage payment so you can come prepared to the negotiation table when it's time for you to buy your brand new home. But before we actually jump into the video, I'm actually going to be diving into a mortgage calculator a little later on and demoing how to calculate this. And this mortgage calculator is completely free. If you log into your App Store or your Google Play Store and type in Recalc free, and then it will pop up at the bottom, and just click this and install it onto your phone because it's a very powerful tool to have on your phone and on the go. Anywhere you go, you'll have access to this mortgage calculator. So I highly recommend that. Again, just simply go to your Google Play Store or App Store and type in Recalc free, and it's going to be this one right here called ReCalc Mortgage Calculator or Real Estate Calc Mortgage Calculator. All right, so you're going to see me demo this calculator a little later on in this video. So let's go ahead and actually jump into it. So how to calculate your mortgage? Well, before you can actually calculate your mortgage, you first need to know how to separate your purchase price from the actual loan amount. So how do we understand what our actual loan amount is if somebody's not actually supplying it to us, right? So to do that, you simply, it's a simple calculation. It's just simply your purchase price minus the down payment, and that will equal your loan amount. So let's use this example. I'm looking to buy a house. This house is going to cost a purchase price of $200,000. Well, we are looking to put 5% down on that purchase price. So we have to calculate our loan amount. We first need to find out what our down payment number is. So I'm going to simply do 200,000 times 5%, which is my down payment, equals $10,000. So 10,000 is my actual down payment dollar amount. So to find out what my loan payment is going to be, I'm going to subtract 200,000, which is the purchase price, minus 10,000, the down payment, and that equals 190,000. So now I know what my loan amount actually is. So remember these numbers, because whenever we go to plug them into the mortgage calculator, we're going to use these same numbers right here. All right, so we only put 5% down. So that's going to segue us to our next segment, and it is your private mortgage insurance, or PMI. So depending on the loan program that you are in, most lenders will charge you an additional fee if you do not put at least 20% down on your home. This fee is known as your PMI, or private mortgage insurance. Your lender, in other words, wants you to have more skin in the game. So how do we go about calculating our PMI? Well, in most cases, your PMI is usually 1% of your loan amount. Notice I said 1% of your loan amount, not your purchase price. That's important. It's 1% of your loan amount. So if we remember from the previous screen, our loan amount was $190,000. So I'm going to multiply 190,000 times 1%, and that's going to give me $1,900 per year fee for PMI. Now, don't worry about all the math, because the good thing about it, I'm going to introduce you to this real estate mortgage calculator a little later on, and it's going to do all this for you. But I think it's very important for you to understand where these numbers come from before you start plugging them in on the actual calculator itself. All right, so let's keep going. So next up is our mortgage term. So most first-time home buyers will be getting qualified for a 30-year term mortgage. That's pretty standard. Most homeowners in general are going to do a 30-year term mortgage. So we're going to keep that standard policy going across here. We're going to use a 30-year term in our actual example as well. So now let's talk about the interest rate versus APR. APR stands for annual percentage rate. Now, you need to understand the difference and which one is actually used to calculate your monthly mortgage payment. Because at closing, you're going to get a lot of paperwork. You're going to feel like you're signing your life away. And you're going to see a lot of different numbers. Well, one of those numbers you're going to be looking at is going to say APR. The APR is simply your interest rate plus all of the fees associated with the loan. That is not the actual rate that you're going to be charged on a month-by-month basis. The actual rate that you're going to be charged on a month-by-month basis is your interest rate, and that is what we're actually going to use to calculate our monthly mortgage payment. So for our example today, we're going to just use a 3.25% interest rate on a 30-year term loan. That's pretty standard right now. And this interest rate will be given to you by the bank. So you will have that already. There's no calculation for you to understand here. I just want to make sure that you take away from this screen is interest rate versus APR. What is the difference? All right. So what is escrow? Well, escrow is property tax and your homeowner's insurance. That's what escrow is. So keep in mind, if you do not put at least 20% down on your home, then most lenders will require that you include your escrow in your monthly payments. So in our example, we only put 5% down. So that means that we will have to include our escrow inside of our monthly mortgage payment. So for example, we will use $2,500 for our annual property tax. Remember that word annual property tax. Now you can go to your county's tax commissioner's website to pull what the previous year property taxes are. For our example, I'm just going to use $2,500 because that's pretty standard for a $200,000 home here in the state of Georgia. And we're going to say that our homeowner's insurance is about $950 for the year. Again, that's pretty standard in Georgia for a $200,000 home. All righty. So this last screen is PITI plus PMI, or principal, interest, taxes, and insurance plus your private mortgage insurance. So what does this mean? That's just a whole lot of acronyms, right? What does all this mean? So once you have all of the information that we just talked about, now you are ready to jump into your real estate calculator, and the goal is to figure out what your PITI plus PMI. This is also known as your monthly mortgage payment, right? This is what you're actually going to be paying your bank or your lender every single month is a PITI. And if you have PMI, which means you didn't put 20% down, then you're going to have to pay that inside of your mortgage too. And you're going to see all of this in a second when we jump into the real estate calculator. It's going to make a little bit more sense because, again, the calculator is going to do all the work for you. It's kind of a plug and play type situation. And then we're going to hit a summary button and you're going to see all the details associated with this. All right, so let's go ahead and jump into our real estate calculator. So what I'm going to do is jump into my real estate calculator. And again, this is download this from the App Store or Google Play Store, the Recalc Mortgage Calculator. And we're going to say that our home that we are looking to buy, remember the purchase price that we talked about was $200,000. So I'm going to go $200,000 purchase price or amount right here. And we decided that we were putting 5% down as a down payment. So I'm going to go 5%. I'm going to hit my down payment. That is $10,000. So again, the calculator is doing all the math for you inside of this actual real estate form. So it's going to do all the behind the scenes that we just did manually on our PowerPoint. So we also know that the bank is going to charge us a 3.25% interest rate over the course of this term. So we're going to say 3.25 and make sure you hit interest rate right here. We also said that this is going to be a standard 30-year term mortgage. So I'm going to go 30-year term right here. All right. If you remember, since we only put 5% down on this house, we also have what's called PMI, what we just talked about. We calculated our PMI as 1% of the actual loan amount. So 190,000 times 1% gave us $1,900. So $1,900 is our yearly fee for PMI. So I'm gonna put 1,900 and I'm gonna hit MI, which stands for mortgage insurance, PMI. We also said that our property tax on this for the year was $2,500. Who can guess what button I'm going to hit next, right? Tax. I have all of this already preset for annual settings. And then the last number that we talked about was our homeowner's insurance, or HOI. And we said that was going to be $950 and insurance right here. Click that button. Now we have all of our numbers plugged into the calculator. Now we're ready to see our summary and see what our mortgage payment is going to be. So let's break it down a little bit further for everybody. I'm going to hit these three dots right here, and it's going to take me to my summary. Now, as you can see, our purchase price was $200,000. We said we put 5% down, so the calculator is smart enough to know that it's going to take 5% from 200,000 is going to give us 10,000. So now our loan amount is 190,000. This should look very familiar from our PowerPoint, right? We said our bank was charging us a 3.25% interest rate for 30 years or 360 months. Now, if you do all of that math, you come out with a mortgage payment of $826.89. But remember, we only put 5% down. So our bank or our lender is going to say, hey, also what you have to include inside of this mortgage payment, you also have to include your escrow. So what is escrow again? That is our property taxes plus our insurance. And we also have, other than that, on top of that, our PMI that has to go and get included into this number too. All right, so let's keep going. Interest only is, if this was an interest only loan, then this is what you would actually be paying per month instead of the mortgage payment. But you're going to be paying the actual mortgage payment here shortly. You'll see that in a second. So total interest, this even breaks down. Hey, if you only make the minimum payment for 30 years, you're going to pay in total of interest payments of $107,681. Or a total payments of $297,681. Where I got that from was $107,000 plus my loan amount of $190,000 gave me that $297 right there. Okay, so let's keep going. Our property taxes for the year was $2,500. But remember, the mortgage calculator is doing all the work for you. It's smart enough to take that $2,500 and divide it over 12 months. So 2,500 divided by 12 is $208. So we know that $208 right there is going to have to get included and added into this 826, which is our mortgage payment. Same thing applies for our homeowner's insurance. The calculator said, okay, you told me $950 for the year. So I'm going to divide that out over 12 months. 950 divided by 12 equals 79 months. And it is also going to include that into your mortgage payment in a second. Remember, this number right here does not quite yet include our escrow, our taxes, and our insurance. You're going to see that in a second. Mortgage insurance, or PMI, we said was $1,900 for the year. The calculator divided that out over 12 months, and it came up with $158.33 right there for us. So now this column right here is our total PITI, which stands for principal, interest, taxes, and insurance payment. And it is this 826 plus our property taxes of 208 plus our homeowner's insurance of 1114. So it comes out to be 1114.39. If we did not have PMI, this would be our total loan payment that we would be paying the bank each month. However, we know that we also have PMI. So we got to scroll down one more notch, and you're going to see the total PITI plus MI, right? A lot of acronyms. The total of principal, interest, taxes, and insurance plus your mortgage insurance. That equals $1,272, because that is this 1114 plus your PMI right here. And this number of $1,272.72 is what is known as your monthly mortgage payment. This is the final number that you are going to be paying the bank or the lender every single month. All right. So that's pretty much it. That's how you actually calculate your mortgage. The good thing about this calculator, if you really want to get down to the nitty gritty, you can click this amortization schedule. If we click this amortization schedule right here, it will show you over the course of 30 years how much you're going to be paying in interest compared to how much you're going to be paying in principal over the next 30 years. And it breaks it down each month for each year. And if you scroll, you won't see until year 9 where you actually start paying more towards principal than in interest. And then as you get further into the loan, then you'll see your principal balance going up. You're paying more into principal and less into interest, which is a good thing. All right. Another good thing about this calculator that I love is if we just go back to our actual, let's go back to our actual details. And if you hit these 3 dots, you have some options here. You can even push these loan details out to email, so you'll have it saved. You can save it in PDF form. So whenever you go to the negotiation table, you have your numbers in front of you. You also have downloaded the app on your phone, so if anything changes, you can quickly calculate it so it looks like you know what you're talking about when it comes to your money. All right. So do me a favor. I hope that somebody out there really got something out of this video. I know it was a short video, but it's short and sweet and to the point. But if you found this beneficial, please make sure that you smash that like button for me. And also please subscribe to the channel so you get notified when we post more videos just like this. Because at the end of the day, our ultimate goal here with Success Finances is to share the knowledge, spread the wealth, and help you build a legacy one investment at a time.